Hello. This is the Centennial Scholars that was supposed to be March 18, 2020. I'm actually recording this on Sunday the 15th, so it's going to take us a few days to post it, and hopefully things don't change too much between now and then. This is my trial attempt at doing a little bit more online. Hopefully, when the next Scholars comes around, we can be doing this in the room with everybody again, but for the time being, I thought it best I'd just do it online. If you have any questions after the end of this, please send them in to me. Give me a call. I'm happy to go through it with you. And also give me some feedback. I'm curious to how this is going to work for everybody. If there's good, bad, ugly, whatever, let me know so I can make it better for next time. So let's get rolling. We're going to cover what I said in my invitation were the three S's: Secure Act, Social Security scams, and the stock market. Now, when I was pulling this together, I thought the Secure Act was going to be the major topic, the focus. Clearly, times have changed, and that's not going to be the case. So I'm going to pretty much rush through the Secure Act and Social Security scams so we can spend some time going through some information on the market. But to start with the Secure Act, this was, I'm going to call it a December surprise. It had originally passed the House in July with only 3 dissenting votes, and then the Senate never touched it. So we kind of assumed that it may be something that happened in 2020, but not 2019. And then it got added to the spending bill at the end of the year. So we had about 2 weeks from when we found out it was in the spending bill until it was active. It applies to IRAs and 401ks starting January 1st of this year. And so it led to some interesting things. It changes the RMD age to 72 for those who had not turned 70 and a half already. So we've had a situation a few times where you have one member of the couple who turned 70 and a half in the fourth quarter. The other was going to turn 70 and a half in January, February, whatever this year. The one that wasn't going to turn 70 and a half until 2020, their RMD age gets pushed out to 72. But if you already had to start taking your RMD, if you turned 70 and a half before the end of 2019, then that doesn't change. So it's a very hard delineation at the first of this year. It removed some restrictions as far as who can contribute to an IRA. If you're still working, if you still have employment income, you can contribute. It does cause a little problem with qualified charitable distributions that we'll get into in a minute, but just be aware, if you're still working, you still have W-2 income, you can still contribute even after the RMD age. And also, probably the biggest piece for most people is the stretch IRA rules were replaced by a 10-year rule. It used to be if you inherited the IRA, you could stretch it out basically over your lifetime. There were required distributions every year, but you were able to stretch it out forever. Now it's 10 years and all the money has to be out. You can do it equally over 10 years, you can do it all up front, you can do it all at the end, but 10 years later, that money needs to be out of the account. So what didn't change? What didn't change was when you can start taking money out. 59 and a half stayed the same. So interestingly, it actually added a little bit of time in there for when you can, but don't have to take money out of your IRA. So it didn't affect people that need to take money out early. It only affected people that don't want to take money out until later. Tax status is still the same. It's still tax deferred for a traditional IRA, tax free for a Roth IRA. None of that changed. And I mentioned the QCDs. This is where things get interesting. So qualified charitable distributions, those stayed at 70 and a half. So you still need to do your half birthday there. But if you are still working and make a contribution, then there's an offset. And that offset continues until you are done with it. So say you're still working at 71 and you contribute $5,000. You cannot take qualified charitable distributions and have them offset or have them not show up on your taxes until you hit that $5,000 mark. It's so you don't put money in and then immediately send it out as a qualified charitable distribution, get your tax rate off, and then for the contribution, and then never have to pay taxes on the money coming out. So I understand why they did it, but it is a little different that way. Social Security scams have been picking up noticeably, at least from what I've seen online. The picture on the right there, that is actually from my cell phone, and that was all the same day. It was on February 25, and on that day, I had 14 Social Security scam calls blocked by my cell phone blocker, which is crazy. And so if I'm getting them, then I'm sure other people are too. And so I thought I'd talk about them just briefly. The biggest thing, the biggest driver is they fake urgency. They make it seem like you have to move right now or something bad is going to happen. You're not going to get your check next month, or somebody's going to be able to steal your money, something like that. The biggest thing to know is the rules of engagement. The Social Security Administration won't call you. They're not going to email you. They use snail mail. They're going to send it out by the Postal Service, unless they're returning a call from you. That's the only time you'll get a call from the Social Security Administration. Otherwise, if it's something important, they're going to mail it to you first, and then it's your job to get a hold of them. Also, don't give out any of your information unless you call them. If you call them and get the Social Security Administration and they need to verify some information, that's one thing. If somebody calls you saying they're from the Social Security Administration, don't give them your Social Security number, because that is probably a scam. And if you have any concerns, hang up and call the Social Security office, explain what's going on, and see if they can help you from there. All right, on to the stock market. Last Thursday, so the 12th, we went into bear market territory on the stock market, which means 20% down from the peak. It was the fastest peak to bear in history. And there's several reasons why. I mean, obviously, COVID-19, which is the coronavirus, is the main driver here. That is what kind of shocked everybody, has really slowed economic activity, and has kind of frightened people a little bit, to be fair. But related to that, we've also had interest rates dropping dramatically, an oil price war triggered by Russia and Saudi Arabia. There's heightened election uncertainty, and we're headed for a possible global recession. And I'll go through all of that, but just to hit on each of those briefly, they're all somewhat related to the virus, but they also have their own independent factors going on. So here's a chart of the S&P 500 showing the recent rises and drops. And you can see from March 9 of 2009 to just recently, we were up nearly 300%. So this recent drop, although staggering, is not much compared to how much we've run up from then. But you can see kind of in the top of the chart, they compare when we went into bear markets for the last two economic cycles. So you have March 24 of 2000, October 9 of 2007, and then March 12 of 2020. So you can see all of those factors and how different things are compared to what they were the last two times. And the big thing to know is we're in a much better place economically than we have been going into bear markets. Employment is still really good. That will probably change over the next few months, but for right now, it's still really strong. I was at Meijer this morning at 6 a.m., and they still have many signs up asking for employees, looking for employees, full, part-time, what have you. They're still hungry for workers. So unemployment's still really low, household debt's still really low. So those factors will probably change over time, but at least going into all of this, financially, we were in pretty good shape. So hopefully that will help cushion some of the blow of what's to come. Oil was one of the big surprises. I did not expect OPEC essentially to implode over the last couple weeks. And here's what happened. They went to the OPEC meeting a couple weeks ago. They thought they had a deal in place to actually cut production and help boost the price back up. Russia did not go along, and so the Saudis and the Russians decided to start a little price war. They ramped supply way up at a time when demand was dropping because China was off work for a month. So that, of course, leads to a steep drop in prices, and they don't mind that because what they're trying to do is drive the U.S. shale producers out of business. The U.S. is the #1 producer of oil at this point, and they would like us to not be. We're not part of OPEC. We're not part of the price setting, the volume setting. So their goal is to drive the price low enough that the shale producers can't compete because it's a more expensive way to get oil and they have to pay their workers a lot more. So that's the idea is we're going to ramp supply way up, drop the price way down. You won't be able to compete. You'll have to shut down, and then we can have our market share back again. This was unexpected. It is somewhat related to the virus, but it's also related to just economic factors that have been going on for a while now. The good news is it'll probably lead to lower gas prices for the summer when people are out doing a little more driving and taking road trips and things like that. Interest rates have been one of the biggest surprises over the last couple weeks. Rates on the 10-year dipped below 1% for the very first time. And it took about a week for the 30-year to do the same. And actually, rates on the 10-year got below 0.4%, which is getting very, very close to negative rates. A little too close for my comfort there. I don't think we'll get to negative rates, but if we have another shock like we had, it's certainly possible. If when you factor in inflation, real yields are negative by quite a bit at this point on the 10-year. So that's something to keep an eye on also. One thing to note, while this has happened in the Treasury market, in corporate bonds and muni bonds, we've seen a little bit of the opposite. We've seen prices drop a little bit. We've seen yields get a little bit better. So we've been able to start picking off corporates and munis again, which we haven't really been able to do for the last several years. This is one of my favorite charts, and it shows the red dots are drawdowns in an individual given year, and then the gray or black bars are where the market, where the S&P 500 finished for that year. So you can see, generally speaking, you get some fairly good volatility in a given year, but that doesn't necessarily mean the market is going to wind up down. 2 years I will point out to you, 1987, where we had an intra-year drawdown of 34% and still wound up positive for the year. In 2009, where we had an intra-year drawdown of 28% and wound up positive by 23% for the year. I don't know what's going to happen over the rest of the year with the market, but just know it is possible that we will bounce back really hard and see similar kind of returns. This chart here shows the average return leading up to and following equity market peaks. And you can see that dotted line there would be the peak. So what I want you to focus on is the right side of the page. So about 3 months after the peak, we're averaged down 7%. Obviously, we're only about a month out from the peak and we're down 20+%. So this is an extreme time. But what I wanted to point out was all the way over to the right, 24 months after a peak, on average, it's down 1%. So we get to a top, we draw down quite a bit, but then within a couple of years, we're usually bouncing back and getting close to break even. That even happened in coming out of the financial crisis. It took another year or so, but we did bounce back, break even, and then go even higher after that. The expectation is that this recovery will be a little bit faster. Like I said, economic conditions were really good coming in. This is virus driven, which makes things a little different. There's not a great playbook because nobody's really experienced it before. But we've got low household debt, good employment so far. And so the expectation is once we can kind of get the virus behind us, things will get running again and we should get rolling pretty good. My base case is that the rest of the first half of the year will be pretty choppy and we're probably going to be really volatile because there's going to be news and it's going to swing the markets one way or another. But that when we get to this summer months, the markets have kind of stabilized, economic activity picks up, we still have rates really low, and so the stock market is the best place to invest, and we have a nice little run into the end of the year. Whether that's enough to make up the difference for what we drop off this part of the year, I don't know, but that is my expectation at this point. This chart comes from a different book at JP Morgan. It's called The Guide to Retirement. The other ones are from the Guide to the Market. And this shows the impact of being out of the market for a period of time over a 20-year span from January of 2000 to December of 2019. So 6 of the best 10 days occurred within 2 weeks of the 10 worst days. And we've certainly seen that in the last couple of weeks where we've had huge down days and then huge up days as well. But if you notice, if you stay fully invested, you get a 6.06 return over that 20-year stretch. If you miss just the 10 best days, if you were in the market the rest of the time and just had the misfortune of selling out just for those 10 days, your return is about 60% less. That's a staggering amount. And if you miss just the best 20 days, you basically didn't go anywhere. Anything more than that, and you wound up with a negative return over 20 years. Now, I can't predict which days are going to have pops and which days are going to have drops. And I'm not a market timer. That's impossible to do. That's why I'm always recommending that we stay the course. We may want to reposition and look at good times to sell and buy, but trying to stay in the market and ride these roller coasters out, generally speaking, is the way to do it and the best way to get a good return in the market. I know I didn't cover election uncertainty that much. The base case for everybody coming into the year was that President Trump was going to win re-election. Obviously, the biggest thing he has to hold his hat on, or hang his hat on, is the economy. And with the economy struggling now, the expectation has changed so that it's more of a toss-up, or so that somebody like Joe Biden would be the winner. That is something to keep an eye on. Obviously, the market has liked the Trump presidency. So if that were to change, then we may see a negative impact from that as well. So we're just going to have to keep somewhat of an eye on that, but we still have a long way to go in the run-up to the election. And then also I touched briefly on possible global recession. I don't think it's going to happen in a country like China because all of their economic upheaval happened in the first quarter, basically. By the time we get to April, they're going to be up and running. I think I saw a story today that they're down to 15 total cases of the virus in the whole country that are still active. So they're going to have economic activity up and running by the start of April. Since a recession is 2 quarters of negative GDP, they're probably only going to have 1, so they'll be off and running. Here in the U.S., I do think we're going to get to a recession because I think this time when everybody's so focused on the virus and social distancing and staying home, is going to straddle the first and second quarter. So we're going to have some impact in February and March, some in April and hopefully not, but possibly May. And so we're going to have that going for 2 quarters. That'll probably lead to negative GDP, probably lead to a recession in this country. But like I said, globally, we may not get there because a big, important country like China to the global economy, they're probably not going to have a recessionary period. It's just not going to last long enough there unless something strange happens. So if you have any questions, give me a call, send me an email. Thought I'd finish off with a quote that I saw from Mark Cuban. He said, I follow the number one rule of investing. When you don't know what to do, do nothing. And in the end, that's usually how it works. You just stay invested, with your money working for you. And, over time, the market moves up and you reap the rewards. But certainly I understand these are unusual times. And so if you do have any questions over something I covered or didn't cover, give me a call, drop me an email. I'd be happy to talk to you. Any questions you have specifically about the presentation, if you can tell me about when in the presentation so I can go back and look and listen, that would be great. But otherwise, just go ahead and give me a call. Let's talk through it. And like I said, if you have any concerns, questions, any feedback on this, please let me know. Hope you have a great day. We'll talk to you soon. Thanks.